Hey guys, welcome back. In today's video, we're diving deep into why AMC is once again setting up for a massive move, why a 300% plus jump is not only possible, but historically supported by data, and why the short sellers are in a far worse position than they were the last time AMC exploded. When you strip away the noise, the headlines, and the daily price swings, what you're left with is a pattern that keeps repeating itself, and right now, AMC is sitting right in the middle of it. It has now been roughly 17 months since AMC hit its all-time low around these same levels. Back then, sentiment was crushed, media coverage was relentlessly negative, and the narrative was that AMC was finished. Yet shortly after reaching those lows, we saw a massive reversal that culminated in a nearly 300% move in a single day. What's important to understand is that this move didn't happen randomly. It happened after prolonged suppression, heavy media bashing, and a period where the stock was pushed down despite improving fundamentals. When we look at where AMC is today, we are once again seeing that same setup forming. Since that last run, AMC's financial position has improved significantly. Box office numbers have strengthened, revenue has stabilized, and the company is in a far better operational position than it was 17 months ago. Yet despite this improvement, the share price has been driven back down close to those historical lows. That disconnect between fundamentals and price action is critical because it tells us that price is not being driven by organic selling pressure. Instead, it reflects sustained suppression. Historically, when AMC reaches these levels under these conditions, what follows is not slow growth, but explosive moves driven by sudden inflows of capital and volume. The last time AMC found itself here, massive amounts of capital rushed in almost simultaneously. Volume surged, liquidity flooded the stock, and price discovery happened extremely fast. Now, what makes this setup even more compelling is that AMC today is fundamentally stronger than it was during that previous run. Stronger fundamentals naturally attract more capital, not less. That means when volume returns, it has the potential to be larger, faster, and more aggressive than what we saw before. This alone is enough to suggest that repeating a 300% move is not a stretch, but there are even more factors stacking on top of this. One of the most overlooked elements is the sheer number of synthetic shares that have been created since the last major run. We've already seen from historical data just how many synthetics can be produced in a single day, let alone over months and years. Every synthetic share represents future pressure. They don't disappear. At some point, whether through expiring swaps, margin stress, or forced covering, that pressure has to be resolved. When those moments arrive, they act as fuel, not resistance. And the more synthetics that exist, the more violent the resolution tends to be. This time around, there are also significantly more pressure points converging at once. Swaps are expiring, liquidity is tightening, and the cost of maintaining short positions continues to rise. All of this increases the likelihood that when buying pressure begins, it won't be met with the same defensive firepower the shorts had access to in the past. Volume doesn't just matter because it moves price, it matters because it overwhelms the systems designed to suppress it. Another major difference this time is liquidity. Short sellers do not have the same level of liquidity they once relied on. We are actively seeing signs of liquidity stress across the market. Reverse repo usage has been declining, margin requirements are rising, and brokers are becoming increasingly cautious. Shorts are being pushed closer and closer to the edge, and that matters because suppression requires capital. Without easy access to money, suppression becomes weaker, slower, and less effective. At the same time, we're seeing additional pressure coming from other heavily shorted stocks, particularly GME. When multiple short positions across the market begin tightening simultaneously, capital has to be spread thinner. That creates a domino effect. Stress in one position makes every other position harder to maintain. AMC benefits directly from this environment because it increases the probability of forced reactions rather than controlled suppression. Now, one concern that always comes up during explosive runs is trading halts. If AMC were to move 300% in a single day, halts would almost certainly be triggered. Those halts are often used to slow momentum and give short sellers time to reposition, but even that becomes less effective when pressure builds faster than it can be contained. We're already seeing early signs of this breakdown. Even on relatively small updates, we're seeing extreme dark pool activity.
At one point, AMC was trading with roughly 70% of volume routed through dark pools, even while the stock was moving higher. That level of off-exchange trading is not accidental. It's a deliberate attempt to suppress visible buying pressure. And yet, despite that, AMC continues to push upward. That's the key takeaway. Suppression is increasing, but effectiveness is decreasing. When a stock can rise despite having the majority of its buy orders hidden, it tells you everything you need to know about sentiment. Retail conviction remains strong, institutions are accumulating, and selling pressure is minimal. Short sellers can create synthetics, abuse dark pools, and build sell pressure, but they cannot eliminate demand. At some point, demand overwhelms the structure designed to contain it. This is why we continue to say that AMC is in a stronger position than ever before. The fundamentals are stronger, the pressure is higher, the liquidity on the short side is weaker, and sentiment remains unbroken. When volume finally arrives in force, the move won't be small, it won't be gradual, and it won't be easily controlled. The data shows that a 300% move is not only possible, but likely a baseline, and this time the conditions suggest it could go even higher.
As we move into the second half of this breakdown, it becomes impossible to ignore just how aggressive the suppression tactics have become, and paradoxically, how ineffective they now are. Dark pools are only one piece of the puzzle. We are also seeing clear evidence of sell walls, spoofing, and artificial resistance being layered into the order book whenever AMC shows even modest upward momentum. These tactics are not new, but the frequency and intensity of their use tell us something important. Short sellers are no longer in control. They are reacting. At the time of recent snapshots, AMC was up over 3% while simultaneously being met with massive sell walls and visible spoofing behavior. This is the definition of desperation. If organic selling were truly present, these tactics would not be necessary. Instead, what we see is constant interference designed to slow price discovery rather than reflect real market sentiment. Despite all of this, AMC continues to push higher, and that resilience is the clearest signal of strength. When you step back and look at the full list of suppression tools being deployed, the pattern becomes obvious. Synthetic share creation, failures to deliver, swap exposure, dark pool routing, spoofing, and sell walls are all being used simultaneously. The fact that so many mechanisms are required at once tells us that none of them are working well enough on their own. Suppression has become expensive, complex, and fragile, and when systems become fragile, they break suddenly, not gradually. This distinction is crucial for understanding price action. There is a massive difference between investors selling and institutions manipulating. In AMC's case, the data continues to show that selling pressure from retail is minimal. Apes are not leaving. Instead, what we are seeing is artificial downward pressure layered on top of persistent buying. That buying may be partially hidden, delayed, or routed off exchange, but it does not disappear. It accumulates, and eventually, it forces a repricing. One of the most powerful indicators of this pressure building beneath the surface is the collapse in reverse repo usage. At its peak in 2022, reverse repo balances reached roughly $2.55 trillion, providing short sellers with easy, cheap access to liquidity. That liquidity was a major reason suppression could continue for so long. Today, that number has fallen dramatically, down to roughly $16 billion. While $16 billion is still a large figure in isolation, compared to where we were, it represents a near total evaporation of easy money. This matters because suppression requires constant funding. Creating synthetics, maintaining short positions, meeting margin requirements, and managing swap exposure all cost money. When liquidity dries up, every one of those actions becomes harder to sustain. That is why we are seeing a shift toward dark pool abuse instead of outright shorting. Dark pools are cheaper. They hide buy pressure without requiring massive capital outlays. But even that strategy has limits because buys still exist, and over time, they overpower minimal selling. The imbalance between buying and selling continues to favor AMC. Estimates consistently show that roughly 85% of activity is buying, with only a small fraction representing selling. Even within that selling, volumes are extremely low. Long-term holders are not exiting. The shares being sold tend to be minimal positions, not meaningful exits. That means supply remains tight, and tight supply